Welcome, everyone, to Name Confidential Live.
Hi, welcome everybody to Name Confidential Live. Today we are joined by Leo Schmidt, CFA. He's the Chief Investment Officer at River Eddy Capital Management and Chair of the Institutional Asset Management Group here at the CFA Society here in New York. Previously, Leo co-managed a $2 billion equity portfolio at Chubb within a $45 billion platform, where his disciplined, value-driven approach generated top quartile performance, averaging more than 200 basis points of excess returns versus the S&P 500 across multiple time horizons. Leo is known for his contrarian fundamentals-first philosophy, with a focus on competitive positioning, balance sheet strength, and cash flow durability. He holds a BA from Columbia University, go Lions, an MBA from NYU, and is a CFA charter holder. Leo, welcome to the show.
Hello, Kenton. How are you?
So, of course, first and foremost, Leo, you've been just an unbelievable mentor, friend, advisor, counsel over many, many years now. I'm glad that our paths have been able to cross so often and with some frequency. And thank you for coming and imparting some of your wisdom here at Name Confidential.
Kenton, thank you. You're very generous to give it those kind words. But you also have been I have a number of people who I mentor, and you're one of the stars. So congrats to you.
You're going to make me blush. But rock and roll, my man. So, you've been, I think when we were talking about the beginning of this prep for this conversation, there's a couple of trends we've been looking at. You've been very active at the CFA Society here with a number of the recent panels, everything across private equity exposure, smaller IPOs, dividend paying. But maybe let's talk a little bit about the stuff that nobody else is talking. Is there any beat up areas or sectors that you think are worthwhile highlighting?
Absolutely. And I particularly like dividend paying stocks right now. And that is the consumer staple world, but you can find them in all over the place, but not necessarily just you can find some of them in tech even. But consumer staples are down 8% for the year versus the market, which is up, probably close to 14, 15%. And the thing about dividends is that in a world where we may have inflation, although the Fed's cutting rates, it's a great way to hedge your bets. And because dividends in theory should grow with the rate of inflation. Because when the dividend discount model, if you use that as an example, it's a nominal just growth rate. It's not an after inflation rate. And so dividends should grow. And that's one way to protect yourself. And it's also a way to protect yourself if you think the market is overvalued, as I do. That said, I don't think the market, there's a lot of dry firewood lying around. But I'm not seeing the spark that's going to create the fire that would have a market meltdown. But but there is a lot of things that when it happens, it will be given the multiples that we're at, we could see a pretty fast drop, but it's hard to know. Could be a slow drop, it could go sideways for 20 years.
Yeah. So let's think about a little bit about this underperformance because, it doesn't, I mean, correct me if I'm wrong, but it doesn't sound like this sector has had earnings weakness. So it's not like the, earnings part of the PE ratio is what's affecting here. It's just generally those earnings are being undervalued. So are you actually seeing industry PE ratios decline downwards as part of that underperformance?
There is some earnings slowdown, but it's not necessarily equal to the 8% drop that you're seeing in the stock price, right? So the consumer, especially the low-end consumer, has been struggling. But that said, a lot of the food companies, Nestle's, Heinz, Kraft, they've all been struggling. And so have some of the dollar stores. I love Dollar General, to pull one out of the hat that I own. Target has been struggling a little bit. And so, those names have had, some headwinds. And, I'll say Nestle's, it's a company that's a Peter Lynch company. Peter Lynch used to say, you want to own a company that even an idiot can run, because sooner or later an idiot will. And Nestle's kind of fits that bill. They've had a whole bunch of stuff. They just had a CEO turnover because of a relationship with an underling. And he had only been on the job for a year, and the previous guy had made some stupid acquisitions. That said, it's a machine that just keeps churning along. And they have tremendous cash flows. They have a fantastic management team, outside of the C-suite, and it will generate cash and dividends for a long time. If not, and it should return to growth. It had above average growth coming out of the pandemic. It should, it's lower than average growth now. It should return to a pretty decent, let's say GDP plus 3 or 6, somewhere in there.
In your experience, how long have you seen the market be able to react to new either earnings guidance or after there's a management change for a large company like that? Because I feel like that's probably one of the catalysts you're looking for if you are looking for multiple expansion coming out of this trough. I mean, I don't mind going in and picking up the yield of the dividends into infinity here, but I think being able to get double dip on returns by also trying to catch a trough here might be one of the catalysts for outperformance.
Absolutely. You always like to have that, you like to have both earnings and multiple expansion, right? So that's the best of all possible worlds. And right now you're getting paid, on 25 earnings, 4% yield to wait, which is not too bad if you don't. So I mean, you're getting cash to wait. So it's yes. So there is time frames. So trying to ship like that can take a long time.
Right.
Doesn't happen on a dime, but it doesn't take forever either. And it is this kind of earnings machine, and you're paying fair multiple. You're paying 16 times, fiscal year 26 earnings.
Mm.
That's not a bad time for way to pay for a 4% in a quarter yield. That's a fair weight, and you have a potential for, let's call it 8 to 12% earnings growth, which should reflect into dividends.
That's well said. What it makes me think of is, I guess what I'm fishing for is a bit of this softer skill that goes along with the behavioral economic impulses that allows the greater market to be able to start reevaluating the future, the value that they're going to ascribe to the future earnings of this company. And I think particularly for the NAAIM audience, there's a lot of momentum and technical members of this trade association. And so very much we see a lot of trend is your friend. And we've seen a lot of growth and a lot of strong performance in trend is your friend, especially through 2025 here. I guess, what's the challenge is trying to see where that trough is going to turn, because you don't want to start betting into the trend is your friend while you're continuing to slide. And I think a unique event like ownership change, like the market getting comfortable with new ownership change over the average time period with which that comfort gets created, really does seem like a very attractive catalyst for, really it's probably just a time weighted acquisition target where you're buying a little bit within the time frame that you think that the market is going to start evaluating this new management team with. I'm wondering if that's something like 2 earnings cycles, like two quarters, 3 quarters, 4 quarters, where we might start seeing this turnaround.
So you bring up a really good question, and I would put that into a big heading of timing, right? And so timing becomes a really difficult place to be, because I do not have a particularly good skill set, although I have opinions, but like it I was going to approach this from a couple ways, but I'll go back to a historical point. In 2007, 2000, going into 2008, you knew the housing market was overvalued. I mean, it was usually housing pricing would be two and a half, three times, medium income. And at that point, it was six times. So you knew there was an overvaluation. And you knew there was lots of weak links all over the value chain, shall we say. You had, liar loans and no, all these crazy loans that were being marketed, and you
Yeah.
just didn't know what it was going to be the impetus. Um, but when it happened, it happened. And so, in some sense, timing is very hard, really hard to know. You don't know what's going to cause that. And so I say the same thing about a lot of stocks. And so one of the things that I try to do is to get out in front of where, like as they say in hockey, you want to be where the puck is going, not where it's been, right? So you have to try to see where things can change, where that catalyst can be that's going to create some value that the market is not looking at. And that is really hard to see sometimes. So I can give you a name that I own now, and I bought it in 2019, although I have owned it all throughout the post dot-com bubble burst, and it's one of the EMS or electronic manufacturing service companies. It's called Celestica, ticker CLS. I bought that in the fall of 2019 at the average cost of $5.80, and it closed today at $233 spot 67. So that's a roughly 4,000% return. And the reason I don't want to say I was a genius with that, because what's happened to all these guys, Celestica, Jabil, Flextronics, Sanmina, they are the guys who build the boxes for the data centers. And so they're benefiting from the AI spend. And they're kind of the picks and shovels of this AI, gold rush.
Mhm.
And I like to call it chicken tech, because you don't know what you're going to be, but they're going to build whatever's going to be out there. So that's one way that kind of like play the tech spend without. So I bought this in 19, not knowing we are going to have AI. Nobody knew there was going to be AI, but we did know that this was a really valuable place to be, and that people are undervaluing what the service that they provided. And so sometimes that's just like, so it's random luck, right? That would get me in front of a name like that. But it's also like understanding what's the value being created and who gets to keep it.
Do you think that, I mean, this chart for Celestica is parabolic.
Yes.
This, how do you understand, is this company really worth 20 times its value of 2, 3 years ago?
I have a hard time justifying that. But, I guess part of that is what you justify the AI spend.
Yeah, I
So
mean, that's really where the question goes. Yeah, what do you think about that?
So I think right now in the near term, it's a gold rush. So it's a land grab. People are running and jumping on everything they can possibly get with names like, for being able to build out data centers and, energy. So all of that is a real fantastic. Now, Celestica, is it worth the valuation? I've been taking money off the table and keep taking money off the table, because I have a discipline. When a name gets to be roughly 5% of my portfolio and it doesn't pay a dividend, I bring it back down to 3. And that keeps me from having a huge blow up on anything, and I still get exposure to the upside. And so this has been one of those names I'm selling and selling and selling, and it just keeps going up, up, up. So I kind of regret selling anything. But, it's a good discipline to keep yourself saying, does it really justify 20 times where it was before? Hard for me to to argue that. But, again, what do you think about AI? And it's really hard for anybody to understand AI at this point. I mean, so am I making sense here?
100%. You know what it makes me think of? I was watching another short clip with Mark Andreessen, and it was comparing the .com bubble and the AI spend that we're doing here. And this particular chart, just like you mentioned, you owned this through the tech bubble, and you must have seen that run up and that
Actually, I bought it after the tech bubble.
Oh, okay. All right. So
I bought it, around so I owned it at Chubb, and we had it, in the portfolio 05, and sometimes we get in, we got out. There's Sanmina, Flextronics, what else? Jabil. So, but most of the we started in around we had 05-ish, and we kind of because they had been clobbered, and Sanmina, which is another one of these rocket ships, um, I mean it was trading at like 3 times cash flow, 4 times cash flow at some point. It was just again astronomically cheap. And because they're out of the tech bubble, they got painted with the big bad brush because they had made lots of bad acquisitions. They had too much debt. They have low margins. They're volatile, and so. But they also grow. And are they worth what they're being priced at now? Probably not. So I keep cutting them back, but they're also running like crazy. And as long as you have this AI money being thrown. I'm going to try and let my horses run a little bit because if I make a mistake as an investor, I'm in too soon and I'm out too soon. That's usually my mistake. Sometimes I'm in too late and out too late too, but that's another story.
Well, this is really one I'd like to dig into a little bit.
Sure.
Well, I guess so. I mean, what other, because this company here, this company makes electronic equipment, right?
Yep. They
So-
basically build the boxes that you're seeing in the data center, if you think about it, but they do so much more. I mean, they do, and all of them have their little specialties, but so Flextronics does medical equipment and they assemble the boxes, and sometimes they do more, engineering, sometimes they do less. But they're all kind of they're like Foxconn, if you want to think about them. That would
Okay.
be their Chinese competitor. But they don't do Foxconn does iPhones. These guys stay away from the high volume. They're doing much more of the low volume, and you can't fail.
How much of this company do you think is protected based off of their existing infrastructure? I guess another way of asking is like, what's the moat here at
The
50?
mode is the know-how, the manufacturing know-how. So it's in the production process. So there is no shall we say, intellectual patent, but it's in the know-how how to build and how to get in and out and how to flex and contract that manufacturing and to bring. So, American companies have outsourced their manufacturing, and these guys have expertise in that. And that expertise is something that you can't, you can't copy without doing it. It's a level of expertise. Now some of them do this better, and when you really understand when their expertise really shows is when you have a downturn, because it's who cuts fastest, who keeps their inventory in the best shape, and who can shrink the production lines. But it's the ability to flex up and down that creates these guys. That's the skill set, and it's a skill that has it's management. It's nothing that you can learn. It's a craft, shall we say, passed down from one manager to the next, which gives it a pretty good moat because you're not going to have a lot of people run into this because of that. I mean, it's manufacturing is a skill set, and it's hard to
Well,
do.
I guess maybe that when you bring up manufacturing, I'm wondering if it's this sort of overarching trend of not just AI, right? Because if it was AI for AI's sakes, I think at 50 times earning with that sort of parabolic growth that it's had here, I mean, really any sort of bad news based off of even a DeepSeek event where a more capable model comes out, is able to do more with less, and then suddenly the growth of these become the next, like the next shopping mall where it's these
Yeah.
evidence of overbuilding.
Yeah.
Or a demand that wasn't there, and a consumer demand that
I mean,
ultimately
you can, if you want to go back to the tech bubble, there's still fiber that's been laid under the ocean that still may not have been lit up yet, 25 years later.
I thought we have a limited amount of dark fiber. You're saying we've got
Well, I
dark.
don't know. It's just that there's so much overbuilding. It's just like we might finally have used up all the excess capacity. Um, but it was huge amounts of, especially undersea fiber. Just,
Well, I guess maybe the aspect of Celestica that I think supports it is this sort of repatriating of industry. Now, I can see that they're a Canadian company, or at least they're based in Toronto. Probably have a fair amount of U.S. exposure, I'm guessing. But if a part of that also is perhaps as we look at U.S. government spending, U.S. government infrastructure spending into technology, having closer to home technology or closer to home manufacturers that even if there is any weakness in the growth of this sector, at least the ones that are closer to home are going to be the first one to pick up
fine.
those mandates from overseas competitors, all else being equal.
Yeah, so all of these types of companies, they have international footprint, but they're also able to put up in, new facilities particularly quickly. And if I'm recalling Celestica, they have a number of US facilities. Uh, and some of these guys, they do defense contracting, so they work for the U.S. Department of War now, the DoD, and you gotta have, U.S. manufacturing. So, um, so they have that ability to, kind of put up new facilities all over the world. That's part of that skill set that that you can build and train and put up new facilities, new lines. Now that takes a lot longer, I mean, than just adding an extra line to an empty facility or reconfiguring a facility. But yeah, that's a skill set.
Tell me if I'm wrong, but the AI spend is an American phenomenon.
A lot, certainly China's doing a lot, but I would agree a lot of this is an American, gold rush. And we have this, that's um I don't want to pretend like I'm an expert at AI because I think right now, no, I think some people have really good skill sets and understand that. But I think the majority of people who, they put AI in their name and in their conference calls and pray for uptick. Not a lot of people know what they're doing. I mean, large language models are, if you're a PhD student somewhere on the, California coast, you may have a good understanding. But, I think it's a lot like the dot-com era. We know it's going to be productive. We know it's helpful. I know there's a lot of mistakes that happen with AI, and it's hard to know who's going to be the big winner. I mean, it's changing search. So all the businesses that kind of came up in the age of cheap capital that were relying on a Google search engine to drive customers to them, they got a serious problem. All those unicorn companies that, we're going to redefine whatever it was in the digital world by relying on Google to send hordes of people to them, that world is going to change probably. Maybe not. I mean, Gemini could be maybe that's the search engine, but how we think about search is going to change. And, so how do you play that game? Or maybe you don't play it. Maybe you try to find businesses that will win regardless of what happens.
I guess what's interesting about this time period is is the interest in the physical build out, right? Because we've been able to see huge amounts of growth in asset light software companies that you could really capitalize off of the existing telecommunication infrastructure.
Yep.
I mean, just you have AT&T and a variety of telcos, the fiber that was planted that created the telecom infrastructure that allowed for the Googles to being able to
Right.
be
Actually, it's cable
Well-
infrastructure.
cable infrastructure.
Yeah, I know, but the telecoms kind of came late to that play. But yeah, I mean that was one of those in the dot-com era. That's one of the things that made my kind of made my career is I was pounding the table for cable, and there was a particular company, Scientific Atlanta, and they missed the earnings, and it dropped like a rock. And I pounded the table. We bought 2% of the company at $13, and 4 months later we sold it at 33. And I was like, wow. But that was because it's the cable infrastructure. They were putting out the cable, and it was the kind of the world at that point is a gift that kept on giving for me because, and I'm bragging, excuse me, but it was just the idea that people thought at that point digital subscriber lines, DSL, was going to be the way forward, and I'm like, no, it's going to be got to be cable, and again, I didn't care who won the war. I just want people to buy bullets. And as long as you're buying bullets in the war, they have to keep buying. And it was a fantastic insight. And, I went up and down the value chain for the cable companies, and it was great. And this is in the similar world. It's like who's going to win? I don't know, but we do know they're going to have to build and spend. And you want to be the people selling the picks and the shovels, or bullets into the war if you want to be safe that way. And by the way, defense contractors are kind of interesting too. But um, but that may be a ship has sailed, so to speak.
Maybe one other way to approach this is, I've looked at this historical multiple expansion that we're seeing, right? And it's pretty hard for the Graham and Dodd and me to
Yeah.
continue to buy in at this, inflated expansion. But I've gotten over it. Like I understand there's a bit of TINA. I understand the M2 money supply growth. I understand we're in a little bit of a new regime. Actually, earlier, on our call, when you mentioned 25 times earnings being, fairly priced for 4% dividend paying stock. I mean, you crack any book that's over 20 years old, they'd think you were like,
Smoking some wacky tobacco.
And so I guess, and pardon the half-formed thought, but I guess what it is that you have a vast amount of multiple expansion that has created a new status quo in the S&P 500 by a lot of market cap driven by asset light software and technology companies. And then you're getting these industrials, you're getting these core facilities, utilities and manufacturers that are able to pick up just by association those equity multiples, even though the kind of return on capital and the ability for you to disseminate that technology widely, like it's so difficult for a manufacturing business to go from making $10 to $20 because you need to build a whole nother facility.
Right. And software can be multiplied very easily, right?
Immediately. Really,
Yeah.
really immediately. Just depending on the
I mean, software as a service, you need more servers, but yeah. But yes,
So
I agree with you.
So how do we kind of get to an intrinsic value of a company like Celestica when it seems like it's just getting this PE multiple that's guilty by association? Because how in the world is it ever going to be able to grow for somebody to think it's going to be worth 20 times the value of this company years ago?
Kendall, I agree with you. So I'm Kenton. I agree with you. It's hard to be a newcomer to this name. I think it would be very difficult. and so that's kind of my point is that for names like this, I've more than made my money. I've taken money off the table maybe I don't know how many times. Why, from the money I put in and the money I've made. So I'm just kind of playing with the house money at this point, and I'm just want the exposure. I don't want necessarily. I'm not trying to knock the cover off the ball with this stock, but I agree with you. The valuation is hard to justify, but I also understand that it may not be over, right? I mean, there is still AI spending that's going. So it's very difficult to know when to get out. But so I've been selling this name. So, full disclosure, I've been selling this name and it keeps going up. So like I said, I bring it back to 3% and it's, and Celestica in particular, I took it down to like a 1% position and it's back to 2 in, 4 months. It's doubled or so.
Yeah, I
Not
guess.
quite. I am not, I maybe, but not, anyways, but yes, I agree with you. The valuation, the justification is really hard.
I
But,
guess.
people are paying, right?
Yeah, I guess I'm trying to pick peaks here because this looks like a really and maybe it's just because I lionize some short sellers that are able to kind of find stuff like this, and
Right.
it's palpable, right?
Yeah.
The insanity that's going around everything AI, everything this. It's like it's so easy for that exuberance to turn a corner. And I think that infrastructure plays like this are some of the most vulnerable to technology advances. It's almost this other idea of, you have these, it's kind of a silly meme that went across is this mother was like, oh, I'm gonna, invest up front to buy my children an iPhone 16 right now while they're young, and they're gonna use that for the next 15 years. It's gonna be fine. And the joke that was being told is like, did you know what phones looked like 15 years ago? And they showed like, a motor, like an
The
old Nokia.
brick. Yeah.
I mean, it's still a flip phone. You can go further for the StarTAC, for the Motorola's, but and then so it just makes me sort of think about the like hard ascribing high multiples to hard infrastructure like this and asset heavy businesses that are ultimately catering to industries that are very mobile.
Yep.
Frankly, for a data center to operate here, over there, somewhere else, their turning on, turning off cost is a lot faster than, let's say, you were doing like a copper smelter,
Yeah.
where which, you're putting a lot of investment into a heavy industry, but that heavy industry is ultimately dealing in physical commodities.
Yep.
When you're putting in heavy industry that's dealing in a non-physical, a digital commodity, it just seems like it's one where in which it can pop.
So let me say this about these electronic manufacturing service companies. They're tech neutral. Right? They're going to be building stuff regardless. They're going to be building medical devices. They're going to be building defense radios. They're going to be, so, and, whatever the technology is, they're going to be probably building it. So yes, that's why I call it chicken tech. They're tech agnostic. Now, is the valuation worth what they have now because they're going to be building something? I think the valuation is a little expensive because you're betting on this AI boom to keep continuing, but it's going to continue for a while. I mean, maybe, it's a moment to step out for the macro economy and, I'm not sure we should be cutting rates, but we're certainly because I think the economy is kind of booming. I mean, certainly we're not adding workers, but we're not cutting workers. And the economy, second quarter, and the latest revision was like 3.8%. That's dang good rate of growth. We're not seeing anything to slow the growth. And and I mean maybe tariffs will help us slow. Tariffs would do Jerome Powell's job for him so he can cut rates. So but the economy is okay. it's sort of like I said in 2007, 2008, you can see overvaluation. You can see there's been years of too much investment, and we have unicorn companies and money that's been misallocated. And there's going to be a problem. You don't know when. And so you can be, I mean, you can go back to, I mean, if you want to look historically, if you take a look at 1997 and said you thought the stock market was overvalued, you would be 100% correct, because in 5 years you would have been much better to be in cash. But if you had done that, you would have missed three of the best years ever, pretty much, and you would have been fired as a manager because you would have missed out on all that upside. So one of the things that's difficult is, understanding, where you are and how you, want to be with that. But so I have the luxury of being managing my own money, so I don't have to answer to clients, which is a good thing. At Chubb, we had a very understanding board, and that was an excellent thing because that gave us fantastic ability to have a long-term point of view. So, but it's really hard to know when the music's up. I mean, I'm pulling up the S&P chart, and so at the end of 97, you didn't really cross out of that, so we didn't go down below that till like in 2009. It's 12 years later when we finally broke across that peak in 97. I mean, you could have been in cash to 2008 and outperformed. That's, I mean, that's, I mean, I mean, that's profound. I mean, you had ups and downs in that period. You went up, you went down, but yeah, I'm looking at this, you kind of like 2009, you finally crossed over for good, where you were in 1997. 12 years.
Yeah, that discipline is a rare and yeah, very hard to find.
Yeah. So, I mean, so are we in a new bubble? We're not quite like the tech bubble, but we're in a bubble.
Why not?
Why not? I don't understand.
Why not like the tech bubble?
Oh, because we haven't quite gotten to the broad base, all large companies in the tech bubble, like so GE was, through the roof. We don't quite have Cisco's valuation. We had a lot of dot-coms that were cash flow negative. Where nowadays we have a few, I mean, the mega caps that they mint cash. So it's a little different. I mean, as you know the old saying, history doesn't repeat, but it rhymes. So, this is a different bubble. I mean, ironically, one of the names from the tech bubble, Cisco Systems, it's a great play now. It's relatively cheap, and it's one of those things that if you're going to have AI, you have to have networks, and if you have a network, you might as well own the traffic cops, which is all the routers and all the other equipment that has to go into, putting into the data centers. Corning, glass, they make all the fiber optic cable.
I have a very soft spot for Corning.
Yeah, it's been hot lately. I mean, so, there's a lot of, it's again, depiction of the shovels, but I actually think where the real interesting stuff is happening is in, like I said, some of the consumer staples, because we've had a real hard time of it. And if we go into a recession, the dollar stores have historically outperformed. They've had very good same-store sales in every recession going back to 1984. I haven't done it before that, but I've done it. I did it, and I've, way back, when, and I have seen them outperform in down terms because they work like individuals, human families are like businesses. So when you have less cash flow, you cut down your inventory. So you don't have piles of toilet paper waiting around. You might have one roll and you run out, you got to get some more. And it's it's kind of recession, it's digital resistant, right? Because you can't wait 12 hours if you need toilet paper. You got to go out and go to the store and buy it. So yes, you can get it in a 24-hour or less than 24-hour period, but you need it now. So that's when things like that are going to be resistant to this digital AI age, right? Because you need the physical item and you want it now. So that's what happens to the dollar stores is that they are convenient and they're nearby and they're relatively low costs. So when people pull down the inventory of, let's say, toilet paper, and you need it, you go to the local convenience store. I mean, if you went to Walmart, by the time you got into the store and got to the back of the store where the toilet paper is, you could have been, just walking to and from the store, you'd be at the dollar store and back again, let alone the half hour it takes to drive, the 15 minutes to get to the back of the store and then back again. That's convenience, and that's what you compete on. And those stores, those ideas where you have, an analog idea is pretty interesting, and it's, relatively recession resistant. Now, maybe there comes a time when where delivery mechanisms will make that obsolete, but not yet.
That's a good one, Leo. I think that is something that will allow us to conclude. Any other words of wisdom? I mean, that was a lot to think about, I think, with the just the analog analogy at the end of the day. You got to sort of, it reminds me of a hierarchy of needs, right? And when things get worse, your hierarchy of needs changes and becomes more primal. And I think looking at dollar stores as a value bet that fulfills that in a in a recessionary world makes sense, right? It's a thesis that's kind of proved out over time as being a recession resilient. Yeah, I wonder if in a post-globalization world, the dollar store's margins are able to continue to impress shareholders if they're not bringing in cheap crap from.
There will come a point when we're coming out of a recession and that convenience is not valued, and they will again suffer from, whatever the new retail competitor, if it's Amazon or is it Walmart or is it something else we don't know yet. They will suffer, but in the meantime, that competitive advantage of convenience is hard to replicate. And that's, and then so I mean, so you try to get out ahead of some of that. I mean, I like technology, but but some of the technology you don't want to be betting on who's going to win this fight with AI. There's money being thrown at that, and it's like there's some really smart people who are all going after the same thing, and they've all had the same professors. They're all chasing the same thing, and somebody's going to win, but I don't know who. And I think, it's hard to get ahead of that, and it's hard to be insulated from that. So, but I can predict some more of the needs that they're going to have. And some software companies could be, I mean, and chip companies. I mean, NVIDIA is a name that I owned, 12, 13 years ago, and I bought it at an average cost of $12.05, and I sold it at 120, and I regret it. But I'm not crying. I've made tenfold the money.
Yeah, I know. No, I can hear that. Yeah, I can hear that.
And I can give you the thesis for NVIDIA, which just was too much technology. People were saying, oh, it's a PC company, nobody wants to own it. I said, no, parallel processing is really important. And this is not a PC company, right? I didn't know I didn't know we were going to have AI. Initially, it was also the crypto miners. They all loved that because you could, but then there was a second leg. And that second leg, I didn't see who saw AI coming. I didn't. I mean, it's interesting because AI, in my view, is a evolutionary, not revolutionary technology. And I might be wrong on that, but it's taking correlation and making it an iterative process so that it looks like the machine is learning. And and then you add large language models on top of that, and they learn human language and how to respond to that over time. And so that learning through the iterative process, it's pretty cool.
Very.
But it's evolutionary in my view. Um, but that said, maybe with language that begins to mimic human emotions, that will be maybe that is much more revolutionary than evolutionary. Hard, I mean, I may not be alive to really know that in the end. That's your generation. But I mean, there's other places of technology. So I'm going to just throw in like biotech and immunology. Cancer is going to be a completely different disease state in 20 years, certainly 40. So there's other places in technology that I think are great that are, cutting edge, maybe bleeding edge, because when the biotech, most of them will blow up. So you want the one of two, three, if you can get 3 to 4 that really go through the roof, you've made your money. Two of them you kind of flat, but you got to have at least 20 or more, 40 of them to be in the game.
Any small cap biotech
Yep.
you're looking at?
Yep.
Got
A
any?
thing called Polypid. And they PYPD is the ticker. And they do they put an antibiotic into a polymer that degrades over time in the human body. So when you have surgery, you take the polymer and you put it around the wound and the incision, and they will degrade, releasing an antibiotic where you need it instead of having a system-wide, a systemic antibiotic. And they are very close to getting the approvals that they need and having a partner to market them. So yeah, that's one that could be pretty nice. And this polymer can be used for other things. So you can think about it with cancer drugs or radiation treatments that's specific, that degrades over time, so that you give a consistent level of radiation on the tumor that you need. But that's years down the road. But the use for surgeons and for specific surgeries like the colon, where you have a lot of it's happening. So yeah, that's a kind of a cool technology for me. And it's kind of analog-ish, but it's a biotech. And but immunology, there's some names, but I have some that they may or may not work, and I don't want to tell people to go buy something and I have a total flop on their hands. That this one is this one I don't think will be the flop, but you never know. It's an Israeli company, Polypid. So they have anyway. So does that help?
I think that is a perfect way to end. Leo, thank you so much for your time, your expertise. We covered a wide range of subject, but hey, you gotta diversify. You gotta try to see where those core fundamental values are that drive growth, that drive valuations. And I'm glad that we can both use optimism in terms of the outlook for healthcare and drug technology, with being able to be conservative with convenience of dollar stores, and then also being able to pick up those picks and shovels and be selling bullets to the war as AI continues to expand. Fantastic themes, and I look forward to seeing you soon.
Great, Kenton. Thank you. A lot
Thank
of
you.